It's great to have you. I feel like that was the message that we got from Fed Chair Powell on Friday, which is sort of like, not much I can do about it here because this risks igniting inflation, even if there are growth worries.
Yeah, I think that he's changed his tone a bit because in the couple of weeks ago after the Fed meeting, he was tempted to use the word transitory again. But I think that he sort of walked back on that. But the market doesn't believe him. The market thinks that he's going to capitulate soon enough because that's been the Fed's track record for the last couple of decades. That at the first sign of economic trouble, they tend to capitulate. They did that last September and even before that with SVB. But there's a long history of the Fed having capitulated, and the fact that the Fed has missed its inflation target now for 5 years in a row and will do so for another 2 years. So I'm really surprised in a way as to where the market is pricing in these rate cuts, but also sort of understand it because that's been the Fed's track record going back the last few years, if not decades.
Right. So now we have the situation where the Fed is a little bit handicapped. We have global, you're a very global guy. So let's just talk about what's happening overseas. Hong Kong falling 13% overnight, the worst day since the Asian financial crisis. What's going to happen to global growth?
No, obviously global growth is going to take a hit, but I think that at the end of what's going on here, and something we've spoken about as well, is that the rest of the world is laser focused now on trading without America. So what's happening there is that they're sort of expediting their trade deals of trading with each other, as I've sort of written in the past as well, that if you look at the 10 fastest growing trade routes in the world, only 2 now involve America, 5 involves China and other countries. So the world is moving on, but obviously in the short term, everybody gets hit. But this is a very different kind of market reaction and even downturn that, as you know, that this time, even after the carnage in the international markets over the last couple of days, the US market has really underperformed, and the dollar, in fact, has weakened through this all. So these are already 2 very different reaction functions to what we've seen in the past. And you just pointed out the Treasury yields as well. I think that's a great point you made, because the sensitivity analysis that we had done some time back showed that if there is a US recession, the deficit will widen to 8 to 9% of GDP. Now, what sort of yields should that bring about? Higher yields, I would imagine, not lower yields. So this is a very different environment, and looking at history here may be quite misleading, as we're already seeing in the market's reactions.
Ruchir, I'm interested in, somehow we're going to hopefully get some resolution, quote unquote, on what the tariff rates are and what negotiations look like. But I am curious to know your thoughts about the scarring of credibility to the U.S. and what that does to its ability to draw capital from around the world.
I think it's very significant, partly because, Carl, we went into this with the U.S. being the most overhyped, overowned, and overvalued market in history relative to the rest of the world. That never before had so much capital flown to the U.S. 80% of all flows into the stock market globally went into just the U.S. market this decade. So there's a lot of unwind of that which has to happen, and a lot of that capital came in unhedged, expecting the dollar to appreciate. So that's why, that was something that we discussed was the mother of all bubbles, and that bubble is now being pricked. But this credibility damage is going to last, and I suspect that over the next few years, the U.S. stock market and U.S. assets are going to underperform, no matter how this tariff drama is resolved.
Ruchir, thank you very much for weighing in.